The method that aligns more closely with generally accepted accounting principles is the allowance method. Now, if you remember, the direct write-off method violates the matching principle because we could have the revenues and the expenses on different income statements. So the revenue and the bad debt expense should be on the same income statement. And often, because of the time period between making the sale and giving up finally, can be a long time. And so often they end up on different income statements. So we need to fix that problem to make it more align more closely with accounting principles, specifically the matching principle. So as an example, let's say that we completed $700,000 of consulting services on account. So let's just put together that journal entry. We'd have accounts receivable, $700,000. And remember, right now, we'd probably put everybody's names who owes us that money. And then we'll have sales revenue, $700,000. And if this happened in December, by the end of the year, we probably haven't officially given up on anybody yet. That's probably not going to be for months to come. However, by making the sale, we essentially know that someone is not going to pay us. We don't know who, and we don't know exactly how much, but we know it's extremely likely someone's not paying us at some point in the future. So, therefore, we also know there is some bad debt expense associated with this. We need to put some bad debt expense in the same period as the sales revenue. So we're going to, let's say that this happened sometime in December, and then by December 31st, we're like, okay, we haven't officially given up on anyone yet, but there is some bad debt expense. We don't know, again, who, and we don't know exactly how much. So since we don't know who, what we can't do is we can't credit accounts receivable because we have to put someone's name with that. If we put Dave here, we would be taking something off of Dave's bill, and we don't want to do that. We want Dave to pay us. So we can't associate this with somebody exactly because, again, we don't know who's not paying us. So instead, we are going to use an account called Allowance for Doubtful Accounts. I abbreviate this ADA. This is also referred to in some textbooks as the allowance for bad debts. It's the same account, just a slightly different name. So this is a contra asset. If you remember what a contra account is, it is the opposite of an account that it belongs to. So, for example, in the past, we've talked about accumulated depreciation. That is a contra account to equipment. So it is a negative equipment amount, and it always belongs with the equipment. They always show up together. You can't have one without the other. It's the same with the allowance for doubtful accounts. This is a contra asset to accounts receivable. It is a negative receivable, and it always belongs with the accounts receivable. You can't have one without the other. All right, this is also a holding account until we know exactly who's not paying us. This is going to hold our guess of how much is not going to be paid. So we don't know who, so we're going to put it in the allowance for doubtful accounts. And the how much is, well, at this point we have to guess. Again, we don't know exactly how much, but based on our business experience, we can make an educated guess as to how much is not going to be paid. So we look back on our records, and in a different year, perhaps we looked at it and said, you know what, about 1% of our customers don't pay us. 1% of 700,000 is $7,000. So we are guessing that $7,000 is what we are not going to collect. So we make this journal entry on December 31st as an adjusting entry. And now this has effectively put the sales revenue and the bad debt expense on the same income statement. That fixes the matching principle thing. The other thing that it also does is it gives a more realistic view of how much we are actually going to collect in accounts receivable, which the direct write-off method didn't do either. So what would show up on our balance sheet is $700,000 in accounts receivable. And then since this is a contra account, we would subtract $7,000 from it. And so we would have a net realizable value, often abbreviated NRV, of $693,000. So this also gives the financial statement users a little bit more information as to how much we realistically think we are going to collect. So it gives a lot more information. All right, so let's jump forward to May. Let's say on May 1st, we have spent months and months trying to contact Dave, our customer, and Dave, we finally just say, you know what, I've had it with Dave, I give up. I'm just going to write off his account. And so to get rid of Dave's account, now we can put a name on the accounts receivable. Let's say Dave owed us $1,000. So let's credit accounts receivable $1,000. So once we can put a name to the account, now we can use accounts receivable. Most students are tempted to put bad debt expense as the debit. Well, that's a mistake because we already included this $1,000 in the $7,000. So at December, we didn't know who, but we made a good guess as to how much. And now we know who, so we can actually write off the account. If we put it in bad debt expense, it is double counting that expense. So we're not going to put it in bad debt expense. Instead, we are going to take it out of the allowance for doubtful accounts. So we are going to debit the allowance. I also want to show you what effect this has on net realizable value. So at the end of the year, we thought we were going to collect $693,000. That was $700,000 minus the $7,000 that was in the allowance. That got us to $693,000. After we write off this account, we now have $699,000 in accounts receivable. We took Dave's $1,000 off, but we also took $1,000 out of the allowance for doubtful accounts. So that is now only $6,000. The net realizable value is still $693,000. Now this makes sense because at the end of the year we said, well, we have $700,000. We think we're not collecting $7,000, and realistically, we think we're going to get $693,000. We still think we're going to get $693,000. The only thing that's changed is we have identified one of those people that's not going to pay us. So the net realizable value does not change once we write off an account. All right, so the allowance method, it requires a lot more estimates. It requires adjusting journal entries and guessing and all of this stuff. It is the more accurate method to do, at least based on accounting principles, the matching principles specifically. But it is a lot more complicated than the direct write-off method. Now, the next thing that we're going to look at in the next video is how do we come up with the estimate in the first place? In this video, I just did a simplistic version. I said, well, in our past experience, 1% of our customers didn't pay us. There are other methods to do this estimate, and we're going to look at 2 or 3 of the actual methods that businesses use to make that estimate in the first place.